This week, the world stopped being merely more dangerous, it became more expensive to keep running. This is the Chaos Brief for the week of July 20th through the 26th. I'm Alex Thorne, and this is Thrive in Chaos. The Chaos Index this week is 88 out of 100. Phase R, up 3 points on the smooth line, and the system type has a specific name this week. Inflationary disorder. I'll explain why that label, and not a vaguer one, is the whole story. Section 1. The second door. For 6 weeks this conflict was a Gulf problem. The Strait of Hormuz, the channel that carries about a fifth of the world's seaborne oil, has been near a standstill. But Saudi Arabia had a workaround. It shipped crude out the other way, through the Red Sea. This week, someone attacked the workaround. Yemen's Houthis struck 2 Saudi oil tankers in the Red Sea, the Enselia and the Layla, and declared a blockade. And here is the mechanism that matters, because it is not the same as another strike in the Gulf. Hormuz and the Red Sea are each other's backup. When one route is blocked, the world reroutes through the other. But an attacker who threatens both at once does not double the disruption. He removes the redundancy. A system with one blocked route reroutes. A system with both main routes unreliable stops being able to reroute at all. That is why oil crossed $100 a barrel this week, the highest since May, touching $102 before it settled. Notice, though, what happened Friday. Oil fell about 4%, back toward 97, on reports of ceasefire talks. The market is still willing to fade the escalation. That mix, a real spike, but a market that keeps testing the exit, is why we set the index at 88, not 90. We are holding room in the number for the scenario where both corridors actually close. That has not happened yet. Section 2. Why inflationary disorder? Here is where the week earns its label. An oil shock does not stay in the oil market. Watch the chain. War risk pushes up oil. Oil pushes up inflation expectations. Inflation expectations push up bond yields. A bond yield being the annual return investors demand to lend a government money, the number that quietly sets your mortgage rate and every company's cost of borrowing. This week the 30-year US Treasury yield touched roughly 5%, its highest since May. June inflation came in at 2.7%, and the categories rising fastest, furniture, toys, household appliances, are exactly the tariff-sensitive ones. And that is the second engine. In the same week, the United States moved to tariff 60 economies at 10 to 12.5%. A one-off tariff is uncertainty a company can wait out. A tariff wall across most of your trading partners is not uncertainty, it is infrastructure. It becomes a permanent line in the cost base. So now 2 independent forces, a contested oil corridor and a broad tariff regime, are pushing the same direction on the same variable, the price level. When the energy shock and the trade shock both target inflation, the central bank's room to cut rates closes from both sides at once. That is not generic, systemic risk. It is disorder transmitted specifically through prices. Inflationary disorder. Topic: the pattern. Step back and the week has one mechanism running underneath everything. Call it defensive capital lock-in. The whole world is doing the same thing at once. Governments are stockpiling energy. Chipmakers are locking in years of capacity. Businesses are redesigning supply chains around tariffs. Shippers are rerouting before a corridor fully closes. Every one of these moves is rational. Every one of them is also expensive. And each one spends flexibility. A strategic reserve is not new supply. It is future supply, brought forward. A long-term contract does not remove risk. It trades procurement risk for commitment risk. A duplicated supply chain protects continuity and raises fixed cost. The world is buying certainty against the danger it can see, using the capital it would need for the danger it cannot. And that creates a new kind of fragility. The more you harden against the shock you expect, the less room you keep for the shock you don't. A resilient system is not automatically a flexible one. That distinction is the most important idea in this week's brief. Section 4. Where it lands. This is not just a Gulf and Washington story. Watch South Africa. Inflation there rose to 5% this week, a 2-year high, driven by transport and fuel. And it is now likely to force an interest rate hike. A conflict thousands of kilometers away is already raising borrowing costs for households on another continent. That is the transmission chain, visible in the data, in a country with no direct role in the Middle East. Meanwhile, wildfires in France forced around 197,000 people to evacuate, with military support deployed. Climate adaptation is becoming an urban operating cost, funded at the same time as higher energy, higher defense spending, and higher interest bills. Every one of these competes for the same scarce pool: capital, energy, skilled labor, government capacity. Section 5. What you do. So here is one action for each audience. If you're an individual, increase your financial flexibility now, before higher energy and financing costs reach your budget. Take your worst combination of fuel, transport, and debt payments, add 15%, and check whether 3 months of cash covers it. Do not treat 1 month of lower oil as proof the pressure is over. If you run a business, model tariffs, energy, freight, and borrowing as one combined stress scenario, not for separate ones. They interact, and testing them separately understates how much working capital you actually need. And measure time to substitute, not number of suppliers. 5 suppliers on one shipping corridor is one dependency wearing 5 costumes. If you manage capital, separate the companies that sell resilience profitably from the ones that merely spend heavily in its name. High demand and poor shareholder returns can live in the same stock. With the 30-year yield near 5%, any business model that needs cheap debt is being repriced right now. Close. One closing thought. The whole world is trading its flexibility for protection this week, in public, at scale, against the danger it can see. The stabilizing move is to guard yours. Keep some liquidity uncommitted, keep some skills portable. Keep one obligation lighter than you could afford, precisely so the next surprise finds you with room to move. What holds is not the thickest armor, it is the room left to turn. That's the Chaos Brief for this week. Signal over noise. I'm Alex Thorne. I'll see you next Sunday.